Good morning, Iggy. With all the headlines around Trump's Asia tour and the big showdown with Xi Jinping, I wanted to pick your brain on how this is shaking up things for Singapore investors, especially with all the noise around tech and pharma. Can we dive into what's actually at stake right now?
Good to see you, Ivanna. You're right. This week feels like watching a high-stakes poker match play out on a global stage. The timing of Trump's visits, Malaysia, Japan, South Korea, and then that sit-down with Xi on October 30th could mark a turning point for trade flows in Asia. As you know, I'm Iggy, and I spend my time covering stocks, finance, tariff, and strategies for growing wealth at the Investing Iguana. Our channel's been recognized for its insights. We were ranked 8th in the 2024 Influential Tigers by Tiger Brokers, just crossed 1 million reads, and our videos total over 600,000 watch hours as of August 2025. I keep a close eye on regional and global trends, and this Trump-Xi standoff is about more than just politics. It's about reshaping everything from rare earth supplies to semiconductor supply chains.
Let's start from the top. Trump's trade talks have a direct impact on Malaysia's tech sector, right? What's happening with those semiconductor deals there?
Malaysia is playing a risky but potentially rewarding game. The government says negotiations with Washington are 99.9% done, and they plan to sign initial agreements covering semiconductors, AI, digital infrastructure, and energy during Trump's visit. But here's a snag. Malaysia still faces a 19% U.S. tariff on general exports, and while semiconductors are temporarily exempt right now, there's chatter about Trump hiking tariffs up to 100% if things go south with China.
Wow. So what does that mean for Malaysia's economy and for Singapore investors eyeing Malaysian tech stocks?
The impact is real. Malaysian GDP growth is already revised down to 4% to 4.8% for 2025. If that semiconductor exemption gets pulled, it could hit their competitiveness hard. Chips make up 40% of Malaysia's total exports, and they're the world's 6th largest exporter. For Singapore investors, firms like UMS Integration, with operations in Penang, offer exposure, but tariff risks mean you've got to tread carefully. It's like walking through a room of mousetraps. One misstep, and the sector could snap.
That's a vivid analogy. How are U.S. companies in Malaysia faring in all this?
Somewhat better. About 65% of Malaysia's semiconductor exports to the U.S. come from American firms with local operations. Companies like Intel, Broadcom, Micron. There's a chance they might get exemptions if Trump follows through on rewarding U.S. manufacturing. But that's not a guarantee.
Turning to China, the rare earth export controls feel like a hidden card in this poker game. Can you break down why rare earths matter so much and how China's new rules change the game?
Sure. Rare earths are the backbone of modern tech. Think electric vehicles, smartphones, semiconductors, and defense gear. China controls about 70% of the global supply, which gives them major leverage. Just this month, they expanded export controls, adding 5 more rare earth elements to their restricted list and imposing tight rules on the tech used for processing. From December, foreign firms must get Chinese approval to export products containing even a sliver, more than 0.1% of Chinese origin rare earths.
So this isn't just about raw materials. It hits companies that rely on any part of China's rare earth value chain, right?
Exactly. It's like China built a moat around their tech and resources, and now you bet you need permission to paddle across, even if your factory isn't in China. The fallout's already showing. The S&P 500 dropped 2.7% after the latest controls were announced, the steepest fall since April.
Singapore has always been seen as a safe haven. Is that changing with these sector-specific risks, especially on pharma?
Singapore's safe haven status is facing some storm clouds, especially in pharma. The U.S. imports $15 billion of pharmaceuticals from Singapore every year. If Trump shifts focus to sectoral tariffs, the knock-on effect could ripple through giants on the STI, shaking the market. Prime Minister Lawrence Wong already flagged this as a concern. Unlike broad tariffs we saw in Vietnam, a targeted strike on Singapore's pharma could really sting.
Are there defensive moves Singapore investors can take? I'm thinking about those who rely on blue-chip stocks and dividend payers.
For defensive plays, look at the financial rails. Singapore's local banks, DBS, OCBC, UOB. With more money flowing internally across ASEAN, these banks stand strong. As core holdings in CPF or SRS portfolios, They offer stability and dividends even when tech and pharma look shaky.
That's reassuring. Back to semiconductors. If Malaysia's deals get rocky, how does that affect Singapore businesses with cross-border operations?
It makes everything a little more fragile. Firms with dual operations in Malaysia and Singapore, like UMS Integration, face extra uncertainty. Analyst forecasts have turned cautious. CIMB, for example, dropped tech sector earnings estimates by up to 11% for the next few years due to tariff fears. Production costs could spike and investment might get delayed.
Is there any silver lining for these tech companies?
The bright side is that some US-based companies in Malaysia could be exempted, which keeps supply chains moving. Also, elevated valuations in Malaysia's tech sector, 24x forward PE, mean any bad news might trigger sharp corrections. So, holding these stocks requires caution.
You mentioned rare earths earlier. How are Western countries responding to China tightening the taps?
Western governments are hustling to fill the gap. There's a deficit in midstream refining. Think the tech and capacity needed to process rare earths. Now, the US, UK, Canada, Namibia, and Angola are investing in local recycling, refining, and separation. Companies working in these areas could benefit from strategic premiums and fast-tracked funding.
So, Singapore investors should watch rare earth opportunities outside China?
Yes, that's a smart move. We're entering a bifurcated phase. China's tightening supply, while Western industrial policies support new players. Any Singaporean investor with an eye on critical minerals frameworks should track companies in diversified jurisdictions. There's real potential for growth.
And looking towards the immediate future, all eyes are on Trump's October 30th meeting with Xi. What's on the table for that showdown?
Everything, to be honest. Trump wants a deal on everything. Tariffs, rare earths, agricultural trade, even narcotics cooperation. Treasury and trade officials are meeting Chinese counterparts now in the hopes of preventing escalation. If talks fail, Trump's 100% tariff kicks in November 1st, and China could lock down rare earths even further. That could spiral into supply chain chaos for tech, EVs, and defense equipment.
What if they succeed in striking a deal?
That buys everyone some time. A truce extension past November 10th, and maybe a push for a comprehensive agreement early next year. Either way, what happens at that table will echo through regional trade for years.
For viewers who want to go deeper into the charts and case studies, where's the best place to drill down into this data?
All the detailed breakdowns, tables, and figures are up on the Investing Iguana Substack. That's where I get nerdy. If you want to see the nitty-gritty, growth rates, and historical comparisons, you'll find the full written analysis there.
That's fantastic, Iggy. So let's drill down to key takeaways. What should the average Singapore investor be focused on right now?
Here's my short list. Hold Malaysian semiconductor stocks with caution. Watch the sector for tariff updates and be ready to react quickly. Focus on Singapore's banks for defensive, dividend-paying exposure. Monitor the pharma sector for any U.S. tariff policy changes. Look for opportunities in rare earth supply chain diversification. Separate short-term volatility from long-term structural shifts.
Can you expand on what structural shifts means for someone who doesn't live and breathe market cycles?
Sure, think tectonic plates under the sea. Sometimes earthquakes get all the headlines, but it's the slow-moving plates that shape the landscape. Here, ASEAN integration is speeding up. Semiconductor supply chains are fragmenting, and rare earth dependencies are changing the rules of the game. These are the trends that'll reshape investing and trade flows.
I like that analogy. For your personal view, are you seeing a buy, sell, or hold on these affected sectors in Singapore?
For sectors on the front line, like semiconductors and pharma, I'm cautious, so it's hold and watch. Banks and a diversified rare earth plays lean more buy, especially given the defensive angle. My overall advice, stay nimble, diversify, and never bet the farm on a single sector during times like these.
Iggy, that was incredibly insightful. Thank you so much for breaking this all down for us today. I know I learned a lot, and I'm sure viewers will have plenty to chew on. Before we wrap up, for those who truly value this level of insight, what's the best way for them to stay ahead with the Investing Iguana?
My pleasure, Ivanna. It's always great to discuss these crucial topics. For those who are serious about getting ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get my detailed analyses and urgent insights on market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses. If you're ready to join the inner circle and get that early edge, just click the link in the description below to become a premium member today.
Absolutely. Thank you, Iggy, for providing your insightful analysis. I look forward to our next video podcast together.